Hi, guys. Welcome to the fourth episode of WTW, the weekly trading wrap up, where we talk about the weekend markets from a trader's perspective, what to focus on, and what to ignore. So let's begin. Uh, the week of the 9th was, well, it started off with a bang. Syria fallen. Who would have thought that Syria could fall in literally like a day or two once the Assad forces withdrew? But that has large geopolitical consequences for the region, but it also has consequences for the US markets and, in particular, risk off assets like gold and everything that is derived from this Syrian reaction. Like, what will Russia do? What will Israel do? Will they continue to expand their territory? Will Russia come back and retaliate? I mean, they still have bases in the west of Syria. Um, let's see what happens, okay? So as you can see, we're looking at the SPY here, the spider. That's how we always start. And this arrow here denotes Monday. So we have Monday, Tuesday, Wednesday, Thursday, Friday here. It was basically a flat week, nothing much happening, but it started off very negatively, okay? And so how, as a trader, how do we play the Syrian news? What do we look for? Well, generally speaking, geopolitical news does not affect the market in any sustainable way, okay? And as you can see, even though it was a negative week, we went from 608, let's say, to the SPY, and we ended at 604. It wasn't that devastating. It wasn't like a nuclear war or like a 9/11 or something like that. So it wasn't like a big move, okay? But it does have impacts on certain markets like gold, okay? So if you saw the gold market on Monday, where is Monday? It's here. Put a little arrow here. Okay, that's Monday, okay? As you can see, gold was consolidating and then boom, it broke out on Monday, went as high as 26.75, then it settled around 26.60, okay? So as you can see, for the next 3 days, gold went up too. It was very, very reactive to this news, okay? Gold loved this. So, but that wasn't the only thing that affected gold, okay? Besides the Syria news, we had other news as well that would affect gold, but let's get to that later. So for the Syria news, in terms of your general stocks, you shouldn't have any, it shouldn't really bother you, okay? It shouldn't change your general bullish bias that we have right now, okay? But it does affect particular markets like gold more, and it might affect things like Bitcoin, okay? Because Bitcoin, as I keep saying, Bitcoin is a leveraged play on the market, okay? And look what happened on Monday. This is Monday. Bitcoin, this candle, big drop. Yes, it recovered it, but this is a huge drop, okay? So Bitcoin, I don't care what people tell you, it's not going to be a hedge against the market drop or anything like that. Bitcoin, put it in your mind and store it forever that it's a leveraged play on the market. It is highly correlated to the market with a higher beta, okay? So that's how you should look at it. In fact, if you think the market is going to go up and you have no other ideas, you should just buy Bitcoin to get the most leverage possible in a bullish market. Okay, that's like the simplest strategy, okay? So when it comes to a geopolitical conflict, Bitcoin will not help you. If the market goes down big, Bitcoin will go down big. Whereas gold will hold. Like you saw the gold market, it will hold. Okay, it will go up. But if the market continues to go down, gold will go up, hold a bit, and then lag the drop. It won't drop as much as the market, but it will hold its value better than the market in a real geopolitical war or negative situation. Okay, so let's put that theory to bed. Bitcoin is a leveraged play on the market, and gold is its own market. Okay, it usually goes with the market as well, but not necessarily, depending on the news. It's a very crazy asset class. Okay, that's why you should hold it in your portfolio. It is not that. Sometimes it is correlated with the market, sometimes there is zero correlation, and sometimes there's a negative correlation. So that's why, for that simple reason, you should have it as part of your portfolio. So what is the next thing that happened on Monday? Let's go back to the SPY. On Monday, we had Chinese stocks ripping on more China stimulus. See, this is my, okay, let's go to the large Chinese stocks here. This is Monday on the FXI, which is the large cap Chinese ETF. Okay, this is what it closed on Friday. Monday the 9th, huge rip up. Okay, because anticipating big stimulus. Like here, this huge up move was on stimulus. This move was on stimulus. However, the Politburo will be met on Wednesday. Okay, this is Monday, but it would meet on Wednesday and this whole week, and they would decide the level of the stimulus. So the market wants a lot of stimulus because China is in trouble. Okay, there's a big property bubble. Its real estate market needs to be propped up, and it needs a lot of stimulus. So this might not be enough. Okay, and as you can see, for the rest of the week, it wasn't. So my view on China is that this is the kind of push and pull that's going to happen in the next months, quarters, maybe the next year, is that people will demand stimulus. The government will say, okay, we'll give stimulus, but not enough. They're trying to give measured doses because they don't want spark inflation and everything to go nuts. But if you look at the market of China, look, it's still much lower than its peak here in 2021. Okay, much. It's still like a 50% drop. It hasn't recovered, whereas we are at all-time highs. And the European markets, some of them are at all-time highs or near all-time highs, as is the UK market. So China is really struggling, and she wants to stimulate and get it back to the highs because it doesn't want every other market up and China down. Okay, it just doesn't look good. So I predict it's going to announce stimulus upon stimulus, measured doses. It's not going to be enough. The market's going to react nicely, then down until he's just going to have to open up the bazooka and go nuts. And that's the moment you want to be in. Okay? Nobody knows when that's going to happen. It's going to be crazy. But trust me, when it's in, you're going to see a sustained move up. I don't know, let's see the Chinese market where you had here. You're going to see sustained moves up in the Chinese market. Okay? This is years. This is from 2006 to 2007. You had a whole year and 2 years to get in on the action. Okay, and I suspect that's what's going to happen with China, but soon, not right away. Okay, because Xi wants to restart the printing press. Will it happen? I don't know. That's why you have today. Let's go back to the daily chart. That's why you have gold up a lot today. Okay, this is gold on Monday. It's up a lot and will continue to go up, not only because of the Syria news, but also because of the China news and the fundamental news of central banks buying, like the BRICS. Okay, so if you look at the gold market, it's still in the consolidation phase. Okay, it looked like during the week it was going to break out, but then Thursday, Friday, we'll get to that. Okay, so on Monday you had Syria. Let's go back to the SPY, the market. You had on Monday here, you had Syria, you had gold, and you had the Chinese news. Okay, and of course Bitcoin crashed a lot because it is a levered play on the market. So now let's go on to Tuesday the 10th. Literally for the whole week there was no macro data for Monday and Tuesday. The big data was what the market was looking for was on Wednesday and Thursday, where you had the inflation, both inflation gauges, both CPI and PPI. Okay, but Tuesday there was no macro data, and you still had a lot of saber rattling on Syria, so the market went down. Okay, especially when you heard stories that the Turkish military is now entering Syria and is going to try to escalate the war, and that might have an effect on the Kurds as well, because Turkey and the Kurds don't get along very well, so it could open up a new Syrian civil war potentially. We don't know yet, but that's why the market was down on Tuesday. No big macro data, so let's move on to Wednesday. This is Wednesday. Why is it up? Well, because, as we said, the big macro day, CPI number came in as expected. Okay, it was 0.3% month over month, and they got 0.3% month over month. Core was at 3.3%, and That's what they got. There's no different. The expectations are the same. So the market says, okay, everything's the same. Boom. We're still going to have the same theory of, buy the market. Inflation's contained. The Fed is going to be easing. They're on a rate cutting cycle. So let's continue. Okay. What was another big news that came out on Wednesday? Well, they said that Russia is thinking of adding a Bitcoin reserve. So you said Bitcoin Monday and Tuesday down as well with the market, but look, boom, up on Wednesday with the market and with the Russian news. So everybody now, we have companies like Mara, MARA, which is Marathon, Riot, and everybody. This is Mara. Okay, it didn't do too well this week, but you had other securities trying to reenact the MicroStrategy strategy, which is just to buy and hold Bitcoin. Okay, and MicroStrategy is the best at it. It's a levered play, done much better than every other Bitcoin company, but everybody's jumping aboard the MicroStrategy strategy because they see what it did to its stock price, and they just want to emulate. They're just copycats right now. Okay. What else happened on? Let's go back to the general market. Here we are on Wednesday. It was a risk on day. Everything was perfect across the board. Everything was green. Another thing that was announced that I found interesting is that Japan is set to restart a Shimane nuclear plant. So Japan is going back on the nuclear bandwagon. Okay, let's go. URNM is the nuclear ETF. This is Wednesday. Okay, Monday took a big hit with everybody else. Let's put the arrow here. That's Monday. So Tuesday, Wednesday, Thursday, Friday didn't do very well. On Wednesday, it was a little pop-up. But as you can see, it is generally in a consolidation pattern. It's stuck, going nowhere. Nothing big is going to happen yet. So even though this is good news and it might be better for the future, there's still a lot of consolidation that it has to do and break to new highs before this sector is hot again, okay? The good news is that, well, on Wednesday is here. Let's go back to Wednesday. Okay? On Wednesday here, okay, the good news was that Japan restarted its reactor, and we still have a uranium deficit, and we are coming up to a point right now, which is right now and in the first quarter, where uranium stocks tend to do well on a seasonality basis, because that's when a lot of contracting starts getting done. Long-term contracts start getting signed by utilities. Who knows? That's just seasonality. It doesn't necessarily have to play out this year, but that's the only positive that I can think of in this sector. Otherwise, I think it might be stuck for a long time. We need to have some kind of excitement come back in. Otherwise, this is probably dead money. The other thing that you have to be aware of in December especially is tax loss selling. Okay, that's in full effect. And tax loss selling is a strategy whereby people sell their losers so they could realize tax losses to offset against winners. Because if they just sold winning stock and had capital gains, they would pay a large tax fee. So they have to offset those capital gains with capital losses. So they realize the stocks that have been going down. They sell the stocks that are at a loss, and then they have to buy them back later after 30 days. Okay, they do that so they don't have to pay taxes for tax purposes. Okay, and what you see, it is especially brutal in the gold space. Okay, look at this is GDX. This is, let's make it more clear here. GDX is the gold ETF. This is Monday. Okay, this candle is Monday. So on Wednesday, gold did well. Okay, but as you can see, GDX is stuck in a consolidation pattern throughout all of December and November. Okay, this is when people start selling their losers. And if you see GDX, okay, compared to the rest of it, it's not at high. It's close, not really at highs. Okay, and if I go even more, this looks like the high. Okay, it's not even close. If you go to a longer dated chart, this is the weekly chart of GDX. It was as high as 66, 67. okay, we're at 36, okay, and gold is at all-time highs. So you can see how badly the miners are lagging. But once they break through here, I think it's going to go all the way up here. But that's what I'm hoping for will happen after this tax loss selling. And if you follow me on Twitter, you would see that I expect gold to be extremely weak in December. Let's go back to the gold miners, I should say. Maybe gold goes up, but miners will not. I'm telling you. I've seen this 100 times. I'm exaggerating, of course. But I've seen it a lot. Let's go back to the daily chart on GDX, okay? So I'm expecting this to be weak all the way into December and then rip on January, February, March, up until March, okay? This is where I think gold miners are headed in the future, okay? Not now, so I expect weakness. This is what you should be accumulating, actually. I know it seems counterintuitive, but this is where you should be accumulating and getting rid of it in the first quarter of 2025, okay? So tax loss selling is a huge anvil, an albatross around the neck of the gold miners this time of year. But it's, I mean, you see gold holding, like look how high it is, okay? Forget the Thursday, and these are Thursday and Friday. We're looking at Wednesday when gold is Monday, Tuesday, Wednesday, gold ripped. We'll get to Thursday, Friday. But on positive CPI news, gold rips, and yet miners are nowhere to be found. These are gold miners. I mean, it did go up, but look, it's not even close. This is like a perennial loser at this point. It looks like a terrible, terrible chart, okay? But gold looks amazing, and gold miners look crap. That's the nature of the beast. You have to be expecting that, okay? So that's what, let's go back to SPY. So that's what happened on Wednesday, which is this green candle. What else did we get on Wednesday? No, that's about it. Nothing really big. So let's go on to Thursday, which is this candle right here. Okay, it was red, bad, because the PPI came in hotter than expected. And PPI is a producer price index, which is the price that producers pay for their goods, their inputs. So it came in at 0.4% month over month versus 0.2%. That's hot. Okay, so this throws a wrench into everything because the people are trading off of PPI, okay? The most important thing that people are looking at right now is yields, which is a game of higher or lower inflation, gold, and jobs. Gold really is a byproduct of that, but I think the gold market is exciting at this point. We're coming to a point where it's going to go up. But the most important thing that market participants are looking at is inflation, yields, particularly the US 10-year yield, and jobs. And for jobs, we were going to look at initial claims, which on Thursday came out, okay? But first it was the PPI. Okay? And the PPI, because it's hot, it just tanked this market. Okay? Everything went down. Bitcoin, surprisingly, held up Thursday. Came back. This is surprising to me. I see the market going down and Bitcoin going up. That's surprising to me. Okay, now you're seeing some kind of divergence. Okay, because Bitcoin is a lever play on the market. So now something else is going on with you should have a mental note right now that something strange, i.e., good, bullish, is happening with Bitcoin versus the market. Because this should have gone down as well. Okay, but something's happening. It's still Bitcoin is flirting with the highs with the market going down. Okay, that is significant. You should make a mental note of that. Okay, you should be long Bitcoin in this case. Okay, so you will have the PPI, and then the next big thing that came out is the initial jobless claims. Okay, and that you should look at what happened to the initial jobless claims here. Okay, they were at 242,000. Okay, and they were expecting 220. So more people are filing for unemployment. That's not good. This is 2 weeks in a row that it's going up. We should see this. That's good. That means the economy is doing well. And generally going up since January, February, since the beginning of the year. This is a yearly chart, okay? So they're generally going up, but not too much, okay? What you want to see is them holding. Okay, you don't want it to explode, because remember what we saw the chart before. Like, let's go here. See, initial claims rise before recessions. Initial claims rise before the shaded area are recessions. The shaded area here are recessions. This is the 1991 recession. Initial claims were rising before. The 2000 crash. Initial claims were rising before. Same thing here, 2008. So you don't want to see this rising fast, because it's coming close to a recession. Okay, let's go back for a year. It's just 2 weeks that it's been going up, so it doesn't make a trend. But because one of the main things that people are looking at, market participants, that is jobs and inflation and rates, this should be on your radar. Okay, so this is a short-term negative. Okay, let's go back to SPY. But a positive that came out on Thursday is that the U.S. government deficit is at a record $624 billion for the first 2 months of the fiscal year, like in October and November. This is a huge number. Okay, and people always think that a huge deficit means huge debt, and huge debt is bad, so the market should go down. That's not true. Okay, a huge deficit, it's true only when the final event happens, when the big crash happens. Okay, and that's not going to happen now. Otherwise, it's very positive. If you see the Biden administration spending $624 billion over 2 months, that's nuts. That's over 7 trillion a year if it's sustained. That's incredible. Okay, so that's a lot of liquidity being pumped into the market. That's very good for stocks. Okay, so you have liquidity being pumped in. There might be a lag. It might be in effect the next year, but that is a huge plus for our bullish thesis. Okay, whereas the initial jobless claims and the inflation were negative. Okay, so now things are starting to not be as clear cut as before. However, things are still bullish. Things haven't really broken down, as you can see. The market is just consolidating at highs. Okay, and you have sentiment. If you look at the fear and greed index. That's at 50. It's at neutral. So even though we're at highs, sentiment is neutral, which means that it's plenty of room to go higher. Even if it drops lower and it gets into the fear and extreme fear section, it won't be that big of a drop. It might drop down to here, maybe undercut it a bit, maybe goes to 600, which this is a support level. As long as the series of higher lows like here and higher highs is maintained, there's no problem. Okay, so we have some kind of beginnings of problems happening, but it's not enough to completely offset our bullish thesis. Okay, so this is why Thursday started, like, it looked like the market was going to go up and continue to go up to new highs, but after a positive CPI, but on Thursday with a hot PPI and the initial claims going up, it was negative. What we should also be aware of is that Europe, the ECB, on Thursday cut by 25 basis points their short-term interest rate, and which is now at 3.15% as opposed to 3.4% before. So 3.15% is much lower than where the Fed has its rates. Okay, and so let's go to Europe here. Let's see the DAX. As you can see, the difference in the DAX, much higher. These are the all-time high. This is the German market. And even the French market did pretty well. Okay. It went up. This just means there was a dividend that was distributed of $2.19. So just add $2.19 here, because all the market participants got $2.19. So it's pretty much up here. Okay, if you add 219 to 73, you get 530, so you're around here. Okay, so this has been pretty positive, okay, for the French market, because we know the French market Macron is in trouble and all that, it's still holding up pretty well. And the FTSE is still the same. Nothing. Still holding, consolidating, waiting. If it breaks out above here, it's going to be a huge breakout. Look at this long consolidation period. In fact, let's put a note here. Okay, a horizontal line over the highs. Doesn't have to be perfect around these. If it breaks out here and holds out here for like a week or two, this is going to have a huge up move. Okay. They're lowering rates in the EU and in the UK. Okay, this is going to be very positive for markets going forward. Okay, because they're lowering rates at near highs. It's not even, they're not crashing. The market's not crashing, it's lowering rates. So this is generally positive. So you have the European rates are at 3.15, but let's go to the Fedwatch tool here, which we should look at frequently. We are at 4.5%, much higher than they are, much more restrictive. And look, there's a 96% chance that the Fed is going to cut by 25 basis points next week. So that's a guaranteed. Okay, we talked about this previously. Anything above 67% is probably guaranteed. Okay, so there's going to be a 25 cut next week. But Europe is at 3.15. That's just crazy. They're much lower than us there. Everybody's cutting, even Canada's much lower. The States has the most restrictive interest rate policy out there compared to the rest of the world. Okay? So that's the big news that came out on Thursday. Let's see what they expect now. Has it changed? What they expect for next year? We're at 450 now. For next year, they expect it to be around 3.75. Let's say 350 to 4. So 4.25, maybe another 3 cuts after the December cut, which is a guaranteed, which we're going to go down to 4.25. So 350, 370, maybe 2-3 cuts. That's what they're expecting. 2, let's say, more than 3. They're expecting 2 cuts on average, like they're the best probability in December 2025. If something happens that will change his expectations to more cuts, without the market tanking, of course, like inflation going down but the market not going down would be one scenario, like a dramatic drop in inflation and rates while the market's still doing well, and this could go up to 3 or 4. Yeah, then the market, that's in fuel for more for more fire in the market. Okay. So when you saw, let's go back to SPY. So when Thursday's bad news came out and the market went down, it had huge implications for rates. So we're looking here at the US 10-year, okay? And the US 10-year, this is Monday, okay? So let's see here. Let's do it on barrel. Okay, this is Monday. Look, the whole week rates ripped. They were heading down. This is the bond vigilantes. Okay, the US 10-year yield was ripping. It was getting too high. I shorted the yield here by buying the TLT. Looking good, but then back up to the highs in 1 week. This is a big move. So in 1 week, market participants had a huge change in their inflation expectations. Well, how do we know? We can look at the break-evens, which looks at 10-year inflation rate. And look, you can see in 1 week, it went higher. So it's mostly due to inflation expectations ripping. Let's get rid of this. We don't need that. So the 10-year break-even, the US 10-year went up mainly due to inflation expectations. That's my guess. That's what I'm getting from by looking at the break-even rate. It's almost all inflation. So that's because of the PPI print. See, this is a huge move, an exaggerated move here on just a hot PPI print. It's not even what the Fed looks at. It's the Fed's big measure of CPI is the PCE indicator, okay, and maybe core CPI. It doesn't really look at the PPI, but the market looks at that as any small hint of inflation, and the market rips yields. Okay, so you can see where the sensitivity is. Okay, if they're wrong, it's going to really unwind. Okay, but you can see where the market is very jittery, and this is what makes this fear and greed index go to neutral, with the market SPY at highs. This is crazy. So every small tick higher in inflation, whether it's any inflation measure, PPI, CPI, or PCE, the market will react massively. Okay, and this is what makes this market a wall of worry still. Okay, market participants are really, really, really worried about any small uptick in inflation and rising rates. That's it. So you know that that's the narrative. Okay, any change to that, you're going to have huge expectations, huge reevaluations. And especially, I'm looking for the downside. If rates are anything positive to rates going down, will rip this market even higher. And not just rip this market, because as you can see, it's been ripping. Okay, rip it higher, but get people on board to actually believe it. Because now again, people have one foot out the door. Nothing has changed in the 1 month that I've been doing these interviews, these weekly segments, I should say. People are still with 1 foot out the door in this market. It's still a hated market, okay? And mainly due to an uptick in inflation. I don't think inflation will rip because, we're not printing trillions of dollars. Maybe with this deficit spending of 600 something billion in 2 months, that might happen. That might be the wild card that does it. But so far, I don't see that this move in the US 10-year is justified. This is fear-based, in my opinion. And because of that, and because of the fear and greed index at 50, you have a lot more fuel for this market ripping higher. Because this market rips higher on fear, okay, and optimism. If it's optimistic, if everybody's super greedy at the highs, that makes sense. And if everybody doesn't care about inflation, you would see the US 10-year in the fours, between 350 and 4, around this area. Okay, we still have a downtrend. It's still going down, but this throws a wrench into everything. Like this week was an important week. Look what happened in 1 week. It just destroyed things. It destroyed the rates going down. Okay, so the opposite of that is the TLT, which is like the TLT looked like it was bottoming. I bought around here. It comes here, and in 1 week I'm back to break even. Okay, so it doesn't look good for that position. However, I think that going forward, it should go higher. Okay, if I'm wrong, okay, I have other positions that will benefit, even if this goes up. So you have to be able to see things happening before they happen and adjust as they happen, especially if you're wrong. Okay, so let's go back to SPY. Friday is just a continue. There was no big news on Friday. It was just a continuation of what happened on Thursday. And the big takeaway for this entire week is the market's hypersensitivity to anything that has to do with inflation, okay, and yields correspondingly, the effect of initial claims and jobs, because, that does affect inflation. If people are, filing for unemployment, there's not going to be inflation. Okay, rates are going to go down because people are not going to have any jobs and they can't spend money. So initial claims is important because they will lead what happens to jobs going forward, even though that's a coincident indicator, I would say. And for me and my positions, I look at gold. Gold is the canary in the coal mine, and it will tell you what's happening probably before it happens. Okay, so that's it for the week of the 9th. It was action-packed. Yet it doesn't look like it here, but individually you saw Bitcoin ripping and going down, then coming back up and holding at highs. And we mentioned how you should be looking at that and be bullish because it's for the Thursday and Friday, it disassociated from the market. This is Thursday and Friday. It was pretty high given the fact that the market went down. So that should be of note. Initial claims going up is of note. You should take care of that. And you should always look at the US 10-year, if this continues or not. So That's it for the week of the 9th. Looking forward to next week. And remember, nothing has changed. Stay bullish.